Good morning. This is Zafar Iqbal, and today is the 6th of August 2023, Sunday morning, early in the morning, and this is a course for Level 7, ATHE Level 7 Extended Diploma in Strategic Management, and we'll be looking finance for managers. And today we are going to be looking at the learning outcome number 2, which is to analyze financial data for an organization in order to inform strategic decision making. So we, as usual, we need to know the command verbs. You should be able to distinguish different verbs we'll be using in the LO today. You need to be aware of the verb like command, command verbs like evaluate, interpret, assess, and conduct. Now, evaluating is to look at the, you're making your own judgment according to the circumstances, according to the factors that we have on hand, using your own experience, using your own knowledge and evidence. Okay, interpretation, we're going to be, by interpretation, we mean translating information into some kind of a recognizable form, using your own understanding, using your own kind of data to look at the performance of an organization and whatever. You know, so from your own ideas and from your own information which we have available. Assessing is to look at the making your own judgment according to some kind of situation, the data available or other factors that are available. You make your own reasoned judgment. Okay, and conducting is to carry out something, to do something, and to according to your own circumstances. So these are the 4 command words that we need to be able to aware of when we are doing our assignment or when we're looking at the kind of learning outcome. Good morning, Alexander. You okay?
Yeah, I'm good. Thank you. Are you okay?
Yes, fine. Thank you for joining.
Thank you.
Yes, we were just going through the kind of word we will be using, like command and command verbs like evaluate and interpret and assess and conduct. And I was saying that the evaluation means you're making your own judgment according to your own experience, according to your circumstances, according to your own knowledge. And the interpretation means you are translating some kind of information
Right.
to a recognizable form. So you make your own understanding or maybe telling your own understanding according to the performance of organization, or explaining the meaning of something which is understandable in a reasonable way. Assessing is just to make your own judgment according to the standard or to the fact.
Right.
Conducting means to look at or carry out, to do something. Okay, so this is where we got to. Okay, and today we'll be looking at the LO2, which is to look at the some kind of what you call them financial ratio analysis, to be able to analyze financial data.
Yeah. Okay. Okay.
We'll be using ratio analysis. I'm guessing that you have used the ratio analysis in the past, or you haven't.
Well, let's see where it gets us, and I'll get you the answer later. Okay? Because I don't actually know if it translates correctly to Russian.
Okay. So there are two learning outcomes, or there are 2 assessment criteria we'll be looking at. It's a short it's a short learning outcome today. The first one is to look at the reasons for using a ratio analysis, and the second one is to conducting comparing the ratio analysis using a particular data for an organization and comparing it with other organizations. Okay, so these are the 2 learning outcomes and the type of ratios we'll be using. So let's the reason, so let's start number 2.1, which is the reasons for using financial ratio analysis.
Okay.
What's the reasons? So have you heard of the ratio analysis in the past, or you haven't? And you know what?
I can't actually answer you right now. Let's keep going. Okay.
Okay, let's go. So the financial data is based upon financial information that you get. You know, when the company prepares its financial statements like profit or loss account and balance sheets.
Yeah.
So these are all the financial information. These are financial statements. We need to compare. We need to see how do they compare to the past years. We need to see how do they compare with other organizations in the industry.
Right.
How is the company successful? Is the company not successful? You know, what's the profit figure telling us? Is it making a lot of profit, or just the data we have? So we've got to, when we know it's making a lot of profit. So for example, if it's made a lot, 50 million profit, or if it's made 1 million profit, is it a successful company, or is it not successful company? How do we know whether it's a successful company? Maybe this year it's made 50 million profit, but maybe last year it's made 150 million profits. So how do we know if it is successful this year or been successful last year? And how do we know if the other organizations made more profit compared to our company, or made less profit compared to our company? So there's no gauge, there's no standard. So we need to make sure when we're comparing like with like. So the interpretation compares like, yes. Okay. So the purpose of the data, financial data, is to compare organizations with each other. To what extent are they making profit or not, or to what extent are they competitive or not? Okay. So this is very important. When we use financial data, when we use financial statements, we mean profit and loss account, we mean balance sheets, we mean investments, we mean all sorts of health of a company. So it's very important that we look the health of a company and compare it with other organizations, as well as compare it with ourselves, you know, based on the data, previous year data. Okay. So there are a lot of reasons why we need to use these statements. We need to compare these statements for the reasons of our own, so that we know that we are a financial company. We want to make sure that we are a successful company compared to, or you know, how do we compare with ourselves? How do we compare with our competitors? Okay, how do we compare ourselves within the industry? That's the most important reasons. And also another reasons why we use financial statement is to attract investors, so that they can invest in our company, so that they can look at our shares, they can look at our data, and put money into our trust, money into our business. Okay, they will be looking at the return on investment. Suppliers also will be looking at us, whether they should lend their trust or lend their materials to us, because if you might pay later to them, are they going to trust us, right? Lenders, for example, banks, they are concerned with the security of our business. They want to make sure that our assets are enough to pay them back when they need money from us. So suppliers are very important. Of course, employees are interested in the sense that they want security in their jobs. They want to know that the company is going to exist.
Yeah, of course, right.
Because their livelihood attached with our company, and maybe they are paying mortgages, they have families to support, they have houses to look after, they have all sorts of commitments, you know, outside the organization. So they want to know, you know, whether the company is going to employ them for the next, you know, umpteen years or whatever. Yes, potential users like professional advisors, they want to, you know, advise investors, for example, commentators, financial management are interested in the profit of our organization, because they working in it, and so on. So there are many people, of course, there are many people interested in our organization. So therefore, we want to be successful as possible. Yes.
Okay.
And this is why we have a one gauge, which is called the ratio analysis. And this is how we can use the ratio analysis. It's a kind of a simple calculations, i.e. ratio analysis. It's a number of calculations that we can use to look at or a set of data which tells us, for example, we've made a certain percentage on our return on investments. We made certain percentage on our cost of sales, for example, or we earned a 10% profit on our net profit rate. Yeah. So these are all gauges. These are all calculations that we use in order to see where we stand, in order to see how this is affecting our organization and how we can use our resources and how we can use our data to comment on, liquidity ratio and or liquidity position and profitability position of the organization. Now, these ratios are calculations. Okay, these ratios are calculations which is based on our data, which is based on our financial data. Okay, one of those ratios is, for example, if you see in this here is the called current asset ratio. Okay, which is here.
Okay.
Current asset ratio. And this is a part of a liquidity ratio. Okay, and there are profitability ratios which are here, which is to do with profit. Liquidity ratios is to do with your liquidity, i.e. how quickly you can meet your debts, okay, short-term debts.
Yeah.
How liquid you are. For example, if you need $1 million in the next few days, can you meet this? Yes, or you can't meet this. So this is the liquidity ratio, and liquidity ratio are based on current ratio and current quick asset ratio. Now, what they mean by this current ratio is the current assets. So you have to look at your current assets, current ratio, current liabilities. Okay. Now, current assets are something like a stock, for example, debtors. Okay, debtors, stocks, cash.
Yeah.
Okay, so these are some of these current assets, and the current liabilities. Of course, these are your current requirements, like current liabilities. Yeah, current liabilities or outstanding current debts, for example.
Right.
So when we use the current ratio, we mean the current assets or current liabilities. You go to look at the. I'm sure you are able to read balance sheet. Am I correct?
Yes, I do.
Look at the current ratios. We look at the balance sheet, and you look at the collect them, and then you divide one over the other. So you divide the current assets over the current liabilities, and that will give you a kind of a ratio, comparative ratio. And usually we write ratio in here is X semicolon to 1. Okay, 1 against 2 dots and against 1. So if you are comparing 1 against other organization. Okay, so it should be ratio at least should be 1 to 1 because it's X determines here the ratio we have of our own organization compared to 1, which is the standard what it should be. I.e., if you got 1 debt, if you outstanding debt is 1, you should have at least £1 to pay it off.
Right.
For example, if I borrow £1, I should have at least £1 in my bank or in my cash account or in my cash somewhere to meet that requirement. But if I don't have a pound and I borrowed £1, but I don't have £1, I only got 60 pence or 70 pence. Okay, I can't meet my requirements. I can't meet my current requirements. I have to borrow some from somewhere, but nobody will lend me any money. So therefore, I am insolvent, I am illiquid. Okay.
Right. Okay. Okay.
So where do I get 40 pence from in order to meet my £1 debt? I have to either sell my sum of small assets, or I have to borrow money from somewhere, but nobody would lend me. Okay, so the easiest thing is I need to sell my current assets quickly. I have some watch, I have a mobile, I have maybe another desk or computer or a lamp or anything that's very liquid that will get me quick, that will give me cash quickly. I'll sell it in order to meet that. Do you get this?
Yeah.
This is what we mean by current assets. So the organization, when they have current assets, they will have to meet current liabilities for their wages, for their bills, for their suppliers, whatever they have. And they'll be knocking on the door. Can I have some money, please? But the company says we don't have enough current liabilities to meet you. We have only fixed assets. We have only liquid, illiquid assets. So we've got to sell it. So therefore, it's in very difficult position. The company, if they sell their assets, which is fixed asset, then the business will be going down and down or closure side. So we must make sure that we can meet our short-term liabilities. For short-term liabilities, the gauge is at least 1-to-1. Okay, at least £1 against £1 debt. Okay,
right.
This is so this is known as the current liquidity ratio, and there are other ratios like quick in order to determine other assets. So you look at the quick asset ratio, which is the second ratio we need to calculate, which is the current assets minus the stock over current liabilities. Now, current assets, because the stock is one of the biggest items in the current assets, we take the current asset minus the stock, okay, and see what our position is when we take the current stock out of the current assets to determine our liquidity ratio. Okay, so if this again should be at least 1-to-1, and we will see how much our debtors are, and quick asset, can we meet that? So these are the two ratios we need when we are gauging current ratios. Okay, the current asset ratio, which is or sometimes called current ratio or current asset ratio, and then a quick ratio or quick asset ratio, which is current assets minus the stock over current liabilities, and equals to 1-to-1. So the X determines one, your own company against the other standard. Okay, so these are the two ratios we need to calculate.
Okay.
This is known as the liquidity ratio. Okay. Then you have profitability ratios. Okay, we will look at the profitability ratio underneath here. Okay. Financial position, or we need to look at how strong our financial position is, and this is known as the financial position ratios, and we can calculate this by interest cover or gearing ratio. Now, interest cover is determined as profit from operations divided by financial cost multiplied by equals to multiply by times, which is the dividend cover or interest cover. It is what it means. This is how many times we can cover our interest.
Okay.
And this is not written in percentage terms or in compared to other. No, this is written in times, multiplied by times, 5 times or 6 times.
Yeah.
The gearing ratio is the amount of borrowings we have. Gearing is long-term borrowings. So the more the borrowings we have, the more problems we have in terms of when we make low profit. But the borrowings are good when we are making good profit. When we have a return is good, we can borrow a lot of money. But if we don't have enough return, then the gearing ratio should be low. This is also determined in terms of times, multiplied by times, right? So gearing ratio is, i.e. how much borrowing do you have? How much borrowing we have over longer term.
Right.
The third one is the profitability ratio or profitability ratios. And this is, means gross profit ratio or net profit ratio in comparison with your cost of sales or cost of expenses or inventories and so on. So there are multiple profitability ratios that we can calculate. For example, we can calculate here gross profit, this one here, gross profit to sales or gross profit to revenue or gross profit to turnover, right? And this is determined in percentage terms. All these ratios are determined in percentage terms. Okay, so gross profit, one of these is the gross profit. Then you can have a net profit, for example, net profit over your sales, or you can have expenses over revenue, or you can have a profit from operations over revenues, or you can have profit before tax over your total equity, or you can have a net profit from operations over your total assets multiplied by 100. So all these ratios, few ratios we have on the left hand side here, you can calculate them in terms of percentages, and you can look what percentage return you are getting from your revenues. Or okay, so this, for example, if you are making good gross profit, you turn it into a percentage. Okay, you'll say I'm making 50% on my I'm making 50% gross profit on my sales. Now, does it mean that you are making a lot of net profit also? Does it mean you are retaining a lot of profit also? Does it mean you are a good profitable company or not? It depends how many expenses you have afterwards. You know, once you return the gross profit, what are your expenses? So if your expenses are 40%, you're only left with 10% net profit percentage. Why? That means your profit is getting low. Why is it too many expenses? Yeah, so you can look at the expenses, and you can see whether you can control those expenses or you can't, compared to your own your own organization last year, or compared to other organization in your in your trade. So this is why we do these ratios, to compare. Okay. Then you have the use of resources. Now, use of resources determines on your your resources, your stocks, for example. Here you can use them if you are using, for example, using your inventories very nicely. If you are using your inventories efficiently, you can determine an inventory turnover, or what you call stock turnover, how quickly you are churning your stock over, okay, for sale purposes, how quickly you are making your stock turnover in a period of time, right? So the quicker you sell your stock, the more profit you are making. But does it mean you are making a net profit? Does it mean you are a successful company? So the whole purpose of these ratios is to determine your profitability or your success compared to your last period or compared to your organizations. Okay, so you can calculate different assets ratios and trader receivable ratios, and you can stock ratios. So these are in times, multiply in, i.e. multiply how quickly you are receiving money from your debtors, how quickly are you paying your creditors, and so on. So all this, what I'm saying is, these ratios are very important in determining your competitiveness. Okay, and there are different ratios to determine a different picture of the organization. And the liquidity ratios tell you how liquid, how quickly you can meet your organization's debts very quickly. Profitability ratios tells you how profitable your organization is. Financial position tells you how profitable you are. using your resources, how quickly you are using your resources like stocks, like your buildings, like your assets, and so on. So all these ratios are there to determine your competitiveness, right? And these are important in order, the competitiveness is important because you need to compare yourself with yourself, i.e. year on, year out, you compare yourself and you compare with your competitors and you look at the industry. So this is why we need to use the financial statements to determine and make strategic decisions. Okay.
Yeah.
Okay. So therefore, these ratios are very important, and you need to be able to use these ratios to compare, to suggest some kind of ways in which we can improve. You can use this, maybe your boss, maybe yourself as a boss, and you can interpret your data to see how good or how bad you can make decisions. So this is the whole purpose of the, the reasons for using the profit ratios or ratio analysis is to make a kind of a judgmental judgment on your investment decisions and on your compatibility, and to make some strategic decision on in your organization based on financial data. Okay. The second learning assessment criteria, which is looking at the comparing analysis using these ratios. Okay, we can use different ratios. We can use different formulas to use these. One of these is, for example, now look at this return on capital employed. For example, this is formula here you can see on the screen is profit from operations divided by the total equity plus non-current liabilities and multiplied by 100%. So this is in percentage terms. Now what this tells you is return on capital.
Just for a second. So if I get it right, the right formula for total equity and non-current liabilities I get from the previous slides, right? And then when I get them, I can use them to implement the formula of return on capital employed.
Yes. Okay. So the return, return on capital employed measures the total return made by the company on both loans and share capital. It looks at how much you are earning from your loans, whether you are getting loan on capital or share capital. What's your return? And why do we need this? Is because, of course, we said earlier on, your shareholders may be interested, and we want to make sure that you're profitable. We have to make sure that how good resources or how badly you are using your assets and so on. So there are different purposes. Okay. And you can break them down. You can break this formula down into what is total equity and what is total non-current liabilities, right? So profit, i.e. net profit from operations, mean the total profit, okay, over total equity plus non-current liabilities equals to total equity means, revenue multiplied by revenue or total assets minus the current liability. So it's a bit complicated. So you need to look at the figures. You need to look at the total revenue. You need to look at the total assets, and you need to look at the current liabilities, and then use this information, use this calculation to see. Yes. So we have to make, look at the balance sheet of your organization, and you will be able to get this from your company accounts. Yeah. Okay. So when you are doing your assignment, you need to have a good look at your financial statement of your company to make sure you get this. Or if you don't have access to your own company, maybe you can have access to other organizations, companies, by looking at their public accounts, and you can pick up the data from other companies and use that information to compare how good that company is doing, how good or bad that company is. Okay. So return on equity here, you can another profitability ratio is you look at the return on equity, profit after tax over total equity multiplied by 100. Now profit after tax is net profit after tax, of course, and total equity means the total shareholders or ordinary shareholders, how much in money they have invested in the company, and then multiply by 100%, and this will give you a return on your ordinary shareholders on their investment. So why do we need this? Is of course ordinary shareholders want to know how much return they're getting on their investment. Okay.
Yeah.
Okay, because they maybe they want to pull money out of the company, or maybe they want to invest more in the company.
Right.
Do you understand? So of course, when we're making this comparison compared to last year, okay, last year we declared the company declared 10% dividend to ordinary shareholders, and this time the company made a lot of profit but only declared 5%. Yeah, and so does it mean that the shareholders are getting more money this year or last year, and is the company successful this year compared to last year? So you can compare.
Yeah, and it means that if the dividends are less than last year,
Yeah.
would it be profitable for the company to share that kind of information to gain more trust of the shareholders, or to invite another shareholders to the business? So there's always a different paths to take.
Yes. So your voice is a bit construed. Can you just move a little bit somewhere so I can hear?
Oh, I'm sitting right next to the notebook.
So if you don't mind moving a little bit so I can't hear you properly, please, if you
yeah, I'm sitting right next to the notebook, so I'm like,
all right. Okay.
5 centimeters from the camera.
Right. Okay, no problems.
Okay, well, let me just give me a second. I'm gonna switch to my mobile phone. Okay.
Right. Okay. Another ratio we can use is a percentage, profit percentages and expenses ratio, as we talked earlier, gross profit ratio or net profit ratio, which is okay. If you are looking at the gross profit percentage or gross profit ratio divided by the total sales or by the total revenue or by the turnover, it's the same. It means the same thing. Okay, when we mean by turnover or the sales or the revenue, it means the total sales. Okay, so when we are looking at
I'm sorry, is that better? The voice? Yeah,
this is much better, Alexander. This is much better.
Okay. So I was talking before about the percentage of the dividends.
Yes, return on equity.
Yeah, yes. I was talking about that there's always different paths for the company to whether to disclosure, first of all, disclosure the margins and the profits, right? And to disclose the total profits for the shareholders, and they must do it, the company must do it. But I mean that in every path taken and path not taken, there's always a way to gain more trust about the for the shareholder and for potential shareholders. So that's I think the most tricky thing to do. Like if the dividends are less than the last year, how can you remain the trust of the shareholders? Yes. How can you bring on board new ones?
Yes. So if you are declaring less dividend this year, can you attract more investors, or can you retain their trust? Very difficult. to retain their.
So that means that if the profit is better, if the profit is bigger, but the dividends are less, how do you actually get out of this equation?
Correct. You know, you need to satisfy those shareholders. You need to tell them these are maybe expenses, maybe the cost have gone up a little bit, maybe you know, there are like COVID, for example, affected our costs.
Right.
So this is why we are declaring a bit less profit. So you don't need to be worried about this. So or maybe we are investing more in assets, for example, and we have to you know, satisfy those, or maybe we had a lot of debts during this period, you know. So you have to come up with reasons why the reasons are more viable, and declaration of shareholders less. Why did we declare less share you know, shares this year? You know, why did we give less percentage of profit to the shareholders? So you need to get their trust back, because you maybe, you know, you have the costs have gone up, the COVID has affected them, maybe
or maybe you just accepted a new business strategy for another year or another couple of years.
Correct.
Yeah, exactly.
You invested more money into the new ventures, and therefore for next year they'll probably getting more higher return. So there are different ways to satisfy them. But if you just tell them, okay, we made this profit and we didn't declare a profit because we invested money in the bank, they're not gonna believe you. Or maybe you have given yourself the directors have given a lot of rise to themselves, for example,
bonuses,
or maybe they've got a lot of you know, what you call salaries and or loans from the company. Directors have given them a rise and didn't give them to the shareholders. This is a bit unfair. Then they'll be getting suspicious. Right. Okay. So so you got to satisfy the investors and the shareholders. Very important. So percentage. Let's move on. Percentage profit percentage. We can look at the gross profit. We can look at the net profit. I.e., you know, why have the, for example, the gross profit is showing 50% profit, but why is it showing a less net profit? You know, of course, you've got to justify, you've got to look at that. And the gross profit and the net profit is the percentage, shows you the overall profitability of a business, overall profitability in terms of costs, in terms of revenue. So you need to be able to see if you're making a lot of gross profit, good. Does it mean you are translating that into getting a higher net profit also, or your costs going up at the same time and you're not controlling costs? And why not? You know, are you spending a lot of money out of turn, for example? Why aren't you looking at your cost of sales or advertising or salaries, or why are, you know, your net profit lower compared to your other partners or competitors or yourself? Last year? So you need to look at these analysis and compare it to your period last year and compare it with your other competitors. Are in the similar position, or you're only one who is making a lot of profit, but you're getting less in the net profit? Why? What's the problem? So these ratios will tell you. They'll look at your you know, interpretation, and you look at these expenses, and you can control them, and you can't control them. Depends how you look at. So the profitability ratios can be calculated using these, and you can. As I said here, a high expense ratio normally is equal to low operating percentage. So if you have a lot of expenses ratios, you need to, you know, your net profit ratio will be low. And why is it low? Okay. Then you will see where we can control it for next year or next period. We need to look at these expenses. We look at control these expenses. So these are, you know, too much. We need to do something about it. So it's all decision making, Alexander.
Yeah,
all
exactly.
decision making, because you're making strategic decision. You need to make sure that you're analyzing and comparing, okay, and making decisions according to the circumstances. Okay, so there is no hard and fast rule. It depends on you know, you compare yourself and you compare it with others and make decisions accordingly.
Right.
Okay? Yeah. Okay, so this is the profitability ratio. Now, asset turnover ratio means how good, how bad you are using your assets, how efficiently or non-efficiently you are using your assets. Now, assets are like machinery, for example. Assets are your stocks, for example. Assets are your debtors. Assets are your buildings. How efficiently, how inefficiently are you utilizing? Are you laying your machinery idle for most of the time and you're expecting a good return on it? Yes. Or are you utilizing those assets all the time and getting good return on them? Okay. So this is known as the efficiency ratio, or, you know, these will tell you how efficiently you are using your resources to generate your sales, you generate your turnover. The higher the ratio, the higher the return, i.e. the better utilization of your assets. Okay, and this is very important because you are getting, then you are becoming, in other words, lower cost. You know, you're using your lowest cost to get your higher efficiency. You know, your costs are lower and your profit is getting higher because of your using your assets efficiently. Now, your assets here, it says revenue, i.e. the sales, total sales, divided by the total assets minus the current liabilities, or revenue over total assets. So you calculate these type of assets and you know, you utilize, and this is only one of them. Okay, you can break them in order of debtors, in order of creditors, in order of you know, your machinery utilization, hour per hour, and so on. So there are other ratios you can utilize these. This is just a general or you know, just what you call them, one of those ratios to measure the efficient use of the business ratios. Okay.
Right.
Again, liquidity ratios, we've gone through liquidity ratio, which is current assets over current liabilities, or current assets minus stocks, current liabilities. This will show you the extent of how your current liabilities, are you able to meet your current debts against your current liabilities, or how quickly can you meet if you getting into problems. Okay. And so there are other ratios here. There are different ratios: liquidity and use of resources. You can use your inventories over cost of sales, i.e. stocks over your cost of sales multiplied by 365 days, i.e. how the average period to which a business holds an item of inventory, i.e. how many days do you hold your stock before you sell it. If you hold for more days, that means you are using your stock very slowly and your profit is falling down. For example, if you sell one car a year, for example, is that giving you a good return on your stock? Or you sell 3 or 4 cars, or maybe 5 cars, or 1 car a month, which is giving you about 12 cars a year. You know, the more you sell, the more return you will get, the more profit you will get, and the more quicker you will get a new stock and sell and get more profit, rather than holding too much stock and not selling. Okay, but it depends on the type of stock you have. You see, if you have an expensive stock, of course it will take time to sell it. but you will get higher return on it, okay, compared to a small shopkeeper who is turning stock all the time, every day, but they are making a small amount of profit on each item, okay, and they are turning their stock fast every day. But somebody who's selling who was selling machinery and who's selling cars, you know, slow, but making a lot of profit. So you see this point? One is churning stock very quickly, but churning small amount of profit every day, because they are different in firms and to compare to a different organization. So it depends on the trade. It depends on the industry you are in, okay? But if you are looking the other car sellers, if they are selling more cars compared to yourself, then there is an issue, because why aren't you selling very quickly compared to other car sellers, okay?
Right.
If they are selling more cars per year compared to yourself, and you're only selling a small number of cars per year, that means you're not utilizing your assets very quickly, very efficiently.
Right.
And we need to see why not, because you're in the same trade. You can't compare yourself a shop to a shopkeeper, because a shopkeeper will turning stock every day. They will sell stock very quickly because their items are perishable. The items are need people.
Right. It's a different thing.
It's a
Totally different thing. Right.
Yes. So therefore, a shop will compare to a shop. A car dealer will compare to a car dealer. You see, and then you can see, you know, yourself. Are you competitive or are you not competitive? And how many days you take to sell a stock compared to the other car dealer? So you can compare. So if the other person is taking a shorter period to sell a higher number of cars, and you're taking longer to sell a lower number of cars, why? Yeah. So you need to see yourself where you are compared to others. Okay. So this is the stock inventory. The basic rule is, the more you sell, the more profitable you are, the more better you are. The less you sell, the less profitable you are, and the less efficient you are. Okay, that's the thing.
Right.
Because so that means if you keep stock for a longer period, why are you holding the stock? Because it's costing you money. It's costing you insurance. It's costing you rent. It's costing you you know, more to hold that stock. Why are you not getting rid of the stock quickly? Because otherwise it will go out of date, it will go out of fashion, it will go out of design, it will go out of need. People won't. Do you understand? If you
Yeah.
Okay, so this is why we have to look at the inventory holding period. So trade receivable, another liquidity or resources, you can use another ratio, which is called the trade receivable or the debtors ratio. Means total debtors divided by the total sales multiplied by 365 days, means the quicker the quicker people will pay you, right? The quicker you will put that money into business use, and the quicker you will get your sales, and quicker you will reap the profit. Okay, so you don't ask your debtors to take longer to pay you back. Okay,
right.
So you ask, because you may need that cash. You may need to use this particular cash in order to buy more stock, in order to pay rent, in order to pay bills. So why are you letting your money used by other people?
Right.
You need to ask them to pay you quickly. And at the same time, you ask your creditors, i.e., you take longer to pay your creditors, because you have you bought some goods. You ask them to give you a longer credit because you use their money to pay your bills. Do you understand? You ask your debtors to pay you quicker. You can invest, or you can pay ask your creditors to give you longer credit, so you use their money for your own business. So you can have a circulation, a quicker circulation in of profit, and make use of that. Okay, this is the
Right.
Yeah. So this is very important when you are so take longer to pay your suppliers, and ask your debtors
Yeah,
to
and
pay.
quicker to play. For the debtors to pay me back. Right.
Yes. So, this is efficient use of resources. Okay, and also a quick turnover of stock. Quick turnover of stock gives you good resources. The more you turn over your stock, the more profit you're going to make. Even though you make a little percentage, but you are making a better utilization of your stocks and so on. Okay, because this will be giving you a good working capital cycle. It says inventory days and receivables minus payables, i.e. take longer to pay your creditors, ask your debtors to give you quicker, right? And this is give you your financial position, a better position all the time. Okay, financial position. Yes, financial position, it depends on the gearing, as we said. Gearing is how much borrowing you have compared to your equity. So the more you have borrowings, the more problems you have when your profit is less. I.e., if you just like if you have if you have a big mortgage, but your earnings are getting less. If I am not employed and I have borrowings, I have a mortgage, where am I going to pay my mortgage from on the house? But if I have a good salary and I have a big mortgage, I can afford to pay it.
Right.
Yeah. So companies, when they are profitable, they can afford to borrow a lot of money during good periods. But when their bad period starts, they can't afford to pay the big borrowings. So therefore, they need to look at this borrowings, and they need to reduce the borrowings when they are not making a lot of money. Okay.
Right.
Yeah. So this is very dangerous for them. Otherwise, they'll have a hard time to pay, and they may go out of business if they can't afford to. So the gearing shows you the extent to which a company is financed by debt. So the higher the debts you have during low earnings, very dangerous. Okay, the higher you have debts in a higher profitable period, good, because you can use other people's money to pay and make a business good, make business. That makes sense.
Right. Right.
Yeah, so this is very important. And interest cover is also important. In other words, whether a business is generating enough profit to meet its interests over a period comfortably. So this means because you are going to borrow money, you have to pay a lot of interest on it as well. Yeah. So if you can't pay the interest compared to your profit, you are in problems. You are in trouble. So you need to be able to show the interest, how much interest cover can you afford during a bad period and during a good period. Okay. And high earnings means there is a greater risk to shareholders, because if you are paying money to your debtors, i.e. to your bankers on the interest that you have earned on your debts, you are paying less to your shareholders. And then if you are paying less to your shareholders, they'll probably pull their money out and invest somewhere else. So you need to be very careful and see where you are during the interest period, the high interest period and high gearing. So try and avoid high gearing if possible. Otherwise, your shareholders will be affected, and they'll affect your business, because these are the charges that you have to pay all the time before your shareholders get anything. Yeah. You have to pay the interest before, because this is a legal obligation. You got to pay the interest before you pay your debtors, before you pay your shareholders. You don't have to pay the shareholders anything, but you have to pay the interest to the banks before you pay to the shareholders. So if you don't have enough money to pay interest to your bankers, then your interest to shareholders will not get anything, and so your gearing ratio is very risky. Okay, so interest, try and reduce the gearing as possible. Okay.
Yeah.
Right. Okay, so what we've done today is we looked at the ratio analysis, and these ratios are very important. This is the type of ratios you look at and interpret and utilize those ratios to see the financial position of your company. During period, you can compare yourself with yourself, compare on year to year, right? If you're making good profit to last year, does it mean you are profitable organization this year? It depends on other factors like expenses and other factors like costs and other factors like your decision
Right,
making.
right.
And so
Yeah.
all in all, the purpose of the ratios is comparison purposes. Okay, and today we look at different ratios to compare yourself and to compare with others. Okay, you can next you can look at your expenses or your accounts. For example, you look at your marks and expenses accounts, or you can go on to their http://corporate-markspencer.com and look at documents, annual profit, annual reports. You can look at, you can look up at so this 2019, maybe you can go and look up your annual accounts on there, or you can look up at bankers reports. For example, different types of banks, they'll have accounts on themselves, and you look up and see what their accounts are. Okay, now let's quickly look at the merit. Merit result, or merit if you want to claim a merit. Now, merit is when you make your recommendations. You compare these organizations.
Right.
You look at these interpretations. You calculate those ratios and put them into a table, and you compare one or two organizations like Anika and Papaka, right? And you see how they compare with themselves. So when you want to claim a merit, you need to compare and recommend which company is better to invest in, which company is not better to invest in, comparing those ratios, gross profit ratios, operating ratios.
Okay, I see.
Gearing ratios, and why, what's the reasons. Okay, so you put them in a table format, and you gauge some ratios and compare and recommend some. I'm going to invest in this, going to invest based on my calculations. Okay, so this is how we're going to assessing and limitations. What are the limitations of these ratios? Of course, these ratios are not in entirety in themselves. They can if you want to show a good gloomy picture, if you want to show a rosy picture, you can utilize these ratios to attract customers. So it depends how you calculate these ratios. If you want to show a bad picture, of course you need to show the bad ratios. If you want to show the good picture, you need to show the ratios and you hide them, like what you call them, creative accounting. In other words, we talked about. Okay. So you show what you want to show. You don't want to show, you don't want to. So there are limitations of using these ratios as a tool, and you look at these and you say, okay, these are only based on my interpretation. These are only based on the accounts, and we don't know how these accounts are made up, and you need to dig right into them and go and see, whether it's entirely reliable or whether they are not entirely reliable. Okay, so you use your own imagination and limitations, and you tell us your own comments. There are limitations.
Right.
Okay. There are other factors of using these ratios by looking at the pastel factors: political, economic, social, technological, environmental factors. When you are using these ratios, you can also put in other factors like the out of control of our organization, like the pest control, pest analysis, and so on. Okay. when you're going to claim for a distinction, you justify your recommendation. You tell us why you recommend to invest in this particular organization. What's the reason? You know, whether they are current, whether they are different, whether they are worth investing, and what type of policies, what type of strategies they have used. Why, you know, why are you recommending? Why are you, you know, persuading somebody to do that? You know, you're so
right.
Yeah. So when we are coming to using your limitation and recommendation, that will get you a higher mark justification, and this will get you a higher grade. Okay. So basic pass, you calculate these ratios, you will get a pass. Recommending, justifying,
comparing them gets the merit and the in addition with the recommendations to invest in one of those companies. And then the distinction grade is when I like give thorough explanations why I recommend it. Right.
Why do you want to, what's the reason for justification? So based on those interpretation of accounts, you know, based on your own judgment, based on your own conclusions, why do you think this company is best for investment purposes and why it's not? Okay, it's your interpretation, all this. Okay,
right.
Yes, pretty straightforward. There's nothing complicated based on the ratio analysis. Very interesting, very enjoyable exercise using these ratios. Okay, and this is the job for managers, and this is the job for your strategic analyst or strategists like yourself who will recommend to the management which company to invest and which company not to invest. Okay, so so we've covered L02 in a good detail today, and I hope you got something out of this.
Yeah, I got plenty. Thank you very much.
Okay,
thank you.
So have you used it?
Yes.
Alexander, before you go, have you used these analyses before as well, or you're new to them? Or
actually, I didn't use the actual formulas, but I was dealing with like final results. So I'm going to go backwards. So I'm going to go backwards to the roots, to the primary source, right?
Okay, good. So you can use these and see what you come up with.
Yeah, exactly.
It's good. Yes, you're working. I guess you're working in an organization.
No, I'm not actually. I'm not working at the time. I'm kind of between the jobs, but I still have like different resources and sources of information, so I can do some research myself.
So what are you working, or you're currently not working? What are you doing?
No, I'm not working currently. I'm just studying and having a good time, you know, relaxing, because it was 2.5 years in a big corporation. I got a little worked up, and I'm just relaxing now.
Okay, all right, okay. Well, nice. That's good. Maybe you can utilize this qualification to get you a better job or something. Or
definitely.
Thank you very much for joining. And when we are meeting next, is it next week?
Yeah, it's 12th of August, but I was wondering, could we postpone it or move it to another date, because I have a birthday on the 12th. So I'm going to be out of town, so I'm not going to be able to connect to the
Right. No, okay. So what date do you suggest?
We can do 13, or I mean, like or maybe next week.
Okay, I'll talk and see how it goes.
Thank you so much.
Okay, thank you very much, and have a nice day.
Yeah, have a nice day too. Bye.
Bye.